SCHD or SCHG? Which one will actually grow your wealth over the next 10 years? Both are fan favorites. One's packed with dividend-paying giants. The other's loaded with tech stocks shooting for the moon. But here's what most investors miss. The difference in long-term return between these two ETFs over the past decade was over 70 percentage points. And that gap comes with a major trade-off you need to understand before you invest a single dollar. In this video, we're breaking down which ETF gives you smarter growth, better income, and stronger long-term results backed by real data and clear strategy. Because making the right choice now could mean thousands more in your portfolio later. What's the difference between SCHD and SCHG? One is a dividend powerhouse. The other is a growth machine. Both claim to build long-term wealth, but they go about it in completely different ways. Which ETF performs better long-term? That depends on what you value more, steady income or explosive growth. And the answer isn't as obvious as it looks on the surface. Which one's smarter for you? That's what we're here to figure out. This video breaks down every key detail: performance, volatility, taxes, and future outlook so you can invest with confidence. We've analyzed actual historical returns, dug into each ETF's holdings, and considered how market trends could shape the next decade. By the end, you'll have a clear, fact-based answer to the question: which ETF is smarter for your long-term plan, SCHD or SCHG? Most investors look at past performance, but they don't actually understand what they're buying. Let's change that. SCHD and SCHG both track U.S. companies, but the way they pick those companies couldn't be more different. SCHD stands for Schwab U.S. Dividend Equity ETF. It focuses on large U.S. companies with strong, consistent dividend payments. Think Coca-Cola, Verizon, and PepsiCo. SCHD tracks the Dow Jones U.S. Dividend 100 Index, meaning it only includes companies with at least 10 years of dividend payouts and strong fundamentals like high return on equity and stable earnings growth. This ETF is built for income, stability, and long-term value. As of early 2025, SCHD has a dividend yield around 3.6% and holds about 100 stocks. It rebalances quarterly and caps sector exposure, so it's not overly reliant on tech or any single sector. SCHG, on the other hand, stands for Schwab U.S. Large Cap Growth ETF. It's all about growth companies expected to increase revenue and earnings faster than the overall market. It tracks the Dow Jones U.S. Large Cap Growth Total Stock Market Index. Its top holdings are tech heavyweights like Apple, Microsoft, Amazon, and Nvidia. SCHG doesn't focus on dividends at all. In fact, its yield is under 0.7%, but many of its holdings have delivered explosive capital gains over the last 10 years. So here's the key difference. SCHD is about income, lower volatility, solid fundamentals. SCHG is about capital appreciation, high growth potential, higher volatility. Understanding this isn't just trivia. It tells you which ETF is built to match your goals, whether you're aiming for passive income or aggressive portfolio growth. Past performance isn't everything, but when the gap is this wide, you need to pay attention. Let's compare how these two ETFs have actually performed over the last decade. From January 2014 to January 2024, SCHG delivered a total return of roughly 324%, while SCHD returned about 195% in the same period. That's a difference of 129 percentage points, or an annualized compound annual growth rate of 15.5% for SCHG versus 11.4% for SCHD. Clearly, SCHG outperformed in total return, but that higher return came with higher risk. SCHG is more concentrated in tech stocks and growth sectors. This means it's more sensitive to market downturns, interest rate hikes, and valuation corrections. In the 2022 bear market, SCHG dropped over 30%, while SCHD fell closer to 10%. Volatility, as measured by standard deviation, over the past 10 years. SCHG, about 18.6% annualized. SCHD, about 13.1%. That matters. If you're near retirement or can't stomach big swings, SCHG might feel like a roller coaster. SCHD has been more stable even if it grows slower. And during high inflation or rate hike environments, value-oriented funds like SCHD tend to hold up better. Dividend-paying companies often maintain demand and pricing power, making them more resilient. If you want maximum long-term return and can handle big drawdowns, SCHG has historically outperformed. If you prefer lower volatility, consistent income, and steadier growth, SCHD offers better risk-adjusted returns. Here's the twist. Past performance doesn't guarantee future results. Stick around, because in the final section, we'll reveal which ETF could quietly outperform over the next decade, and why it's not the one most investors are betting on. Everyone loves passive income, but not everyone needs it. Your preference between dividends and capital gains can completely change which ETF is smarter for you. Let's start with SCHD. As of 2025, it yields around 3.6% annually, paid quarterly. That means for every $10,000 invested, you're getting about $360 in yearly income, even if the price doesn't move. This is perfect if you want to live off your investments or reinvest dividends for compounding. On the flip side, SCHG only yields around 0.7%. Most of its value comes from capital gains, which means you only see returns when the price of the ETF goes up. Here's where it gets interesting. Dividends are taxed every year in a taxable account, even if you reinvest them. Capital gains, however, aren't taxed until you sell. That gives growth-focused ETFs like SCHG an advantage in tax efficiency, especially in taxable brokerage accounts. But there's a caveat. If you're investing in a Roth IRA or traditional IRA, the tax difference disappears. Dividends in SCHD can be reinvested without tax consequences, making its income advantage more attractive. So, which is right for you? If you're planning to retire early or want consistent cash flow, SCHD's dividends can help cover expenses or be reinvested. If you're younger, in a wealth-building phase, and focused on maximizing future value, SCHG may grow faster through price appreciation and deferred taxes. Choosing between SCHD and SCHG isn't about which is better. It's about how you want your returns delivered, now through income or later through growth. A 0.1% fee may not sound like much until it quietly eats thousands from your future returns. Let's talk costs, taxes, and how these ETFs fit into your overall portfolio. First, the good news. Both SCHD and SCHG have extremely low expense ratios. SCHD, 0.06%, SCHG, 0.04%. That means for every $10,000 invested, you're paying $6 a year for SCHD and $4 for SCHG. Virtually nothing. This makes both ETFs efficient choices compared to mutual funds or active strategies. But cost goes beyond fees. Taxes matter, especially in taxable brokerage accounts. SCHD pays a 3.6% dividend yield, and unless you're holding it in a Roth IRA, you'll owe taxes on those dividends annually, even if you reinvest. SCHG's yield is under 1%, which means there's less taxable income generated each year. So how should you allocate them? If you're investing inside a Roth IRA or traditional IRA, the tax burden doesn't matter as much. SCHD's dividends can grow tax-free, and that consistent income becomes a long-term advantage. If you're investing in a taxable account, SCHG may be the better fit. Since most of the return is capital gains, which aren't taxed until you sell, it lets your investment grow without triggering yearly tax bills. SCHD fits well in retirement accounts where dividends are shielded. SCHG works better in taxable accounts where deferred growth keeps more money compounding. Understanding this distinction lets you keep more of your money, and that's a smarter long-term move. Here it is, the part most investors miss when choosing between SCHD and SCHG. What actually comes next? Over the last 10 years, SCHG crushed SCHD in total return, but past winners don't always repeat. Let's look ahead. SCHG is tech-heavy. Over 45% of its weight is in sectors like information technology and consumer discretionary. That means it benefits massively from AI, cloud computing, and digital innovation. If we enter another bull market, especially driven by tech, SCHG could lead the charge again. But there's a risk. Many of SCHG's top holdings like Nvidia and Tesla are trading at high valuations. If interest rates stay elevated or if a recession hits, these growth stocks could see sharp corrections. Meanwhile, SCHD is rooted in dividend stability. Its largest sectors are financials, consumer staples, and healthcare areas that historically perform well during inflationary periods or economic slowdowns. And in a high-rate environment, investors often favor companies with strong balance sheets and reliable income, like those in SCHD. Another edge, dividends account for over 40% of total stock market returns since 1930. That long-term compounding power can't be ignored, especially when reinvested consistently. So which one's smarter for the next 10 years? If you're under 40, have a high-risk tolerance, and believe in continued tech growth, SCHG offers more upside, especially in a strong economy. If you're risk-averse, Closer to retirement or want reliable income through all market cycles? SCHD is the safer, more consistent long-term choice. There's no one-size-fits-all winner. But when matched to your financial goals and time horizon, one of these ETFs becomes the obvious, smarter investment. If you found this video helpful, subscribe for more weekly ETF breakdowns designed to grow your portfolio smarter. And if you're comparing top funds, check out my video on the best Schwab ETFs for long-term investors, or dive into the top Fidelity index funds that could help you retire faster.